This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Gas demand from the U.S. largest liquefied natural gas producers soared on Friday to near record levels on cooler weather and fewer outages, according to preliminary data from financial firm LSEG. LNG export plants were expected to draw 14.6 billion cubic feet on Friday, the highest for the year and just shy of the U.S. record of 14.7 BCF, recorded in December 2023, and up from the 14.5 BCF recorded on Thursday, LSEG data showed. Natural gas demand from U.S. LNG export plants is important as it has been the main source of increased U.S. demand in recent years.
Oil prices could stall in 2025 as economic weakness in China clouds the demand picture and ample global supplies outweigh support from an expected delay to a planned OPEC Plus output hike, a Reuters monthly poll showed on Friday. The survey of 41 economists and analysts predicted that Brent crude would average $74.53 per barrel in 2025, down from a forecast of $76.61 in October. That is the seventh straight downward revision in the 2025 consensus for the global benchmark, which has averaged $80 per barrel so far in 2024.
Moving on to the top news in the energy sector.
Indonesia remains committed to start implementing a 40% mandatory biodiesel mix with palm oil-based fuel, or B40, on January 1 next year, its chief economic minister said on Friday. Indonesia, the world's largest palm oil producer, currently uses B35, a 35% blend of palm oil-based biodiesel. Minister Airlangga Hartarto said the B40 implementation was Indonesia's concrete contribution to the world, as it could reduce carbon dioxide emissions by about 40 million metric tons.
Freight rates for Russian oil transportation are set to rise amid coming winter season and new sanctions against Russian fleet, three traders said on Friday. Britain has imposed the strongest sanctions to date against Russia's shadow merchant fleet. The new restrictions will affect, in particular, 30 vessels that are part of the so-called shadow fleet, which is used to export Russian oil in circumvention of the Western embargo. Thus, the number of oil tankers under UK sanctions will reach 73. The cost of Urals oil shipments from Primorsk, Ust-Luga and Novorossiysk to India has remained stable for the second month in a row amid a sufficient supply of tankers and an expected reduction in sea shipments of oil in December, the traders said. Next, we have the top news in metal markets. Russia has cancelled an exchange rate duty for coking coal and extended a moratorium on such a duty for thermal coal and anthracite, the government said on Friday, saying the decision was aimed at supporting the coal industry. The duty for coking coal will be cancelled from December 1 of this year, the government said. A moratorium on duties for anthracite and thermal coal of 4 to 7%, depending on the ruble-dollar exchange rate, had been in effect since May 1. It had initially been due to expire on November 30, but has now been extended until the end of the year and beyond.
Dalian iron ore futures climbed to their highest in more than a month on Friday to end the week higher, as a stronger economic outlook for top consumer China lifted market sentiment. The most traded January iron ore contract on China's Dalian commodity exchange ended daytime trade 1.14% higher at 797 yuan and 50 fen, $110.29, a metric ton. The contract earlier rose as high as 806 yuan and 50 fen, strongest since October 14, and added 2.90% this week. The benchmark December iron ore on the Singapore exchange was 0.94% higher at $104.70 a ton, a rise of 3.12% for the week, as of 0721 GMT.
We will now look at the top news in the agricultural sector.
Russia, the world's largest wheat exporter, cut its 2025 export quota by two-thirds, hiked wheat export duties and abandoned import quotas for some staple foods on Friday as the government moved to curb inflation. The Eurasian Economic Union Council said Russia's export quotas for the second part of the export season from February 15 to June 30, 2025, will be 11 million metric tons, down from 29 million tons in the same period this year. The EU comprises Armenia, Belarus, Kazakhstan, Kyrgyzstan and Russia and coordinates the customs and tariff policy of its members. In a separate announcement, Russia's Agriculture Ministry hiked the wheat export duty by over 18% from December 4.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.